In this teaching, we are going to use everything that we've learned and we're going to put it inside of a model. I know that we didn't really go through a lot, but this is the go-to model that I built all of my knowledge from, and based on seeing the weekly bias, based on understanding that I am looking for a one-sided bias inside of my daily chart, inside of the days in which I'm going to trade, I will then go and seek this exact model inside of a lower time frame chart. This is what I want to see before I take my 1 minute trade. But everything I want you to understand that it is based on a weekly and on a daily chart. So the lessons that are required for these teachings are as follows: the weekly bias plus high impact news drivers and the smart money paradigm. The concepts that I used in this teaching are as follows: the weekly bias, determining which days to attack based on weekly accumulation, manipulation, and distribution. We got the algorithmic delivery, the sole purpose of price movement, which is to attack liquidity pools and to rebalance inefficiencies. So this is the only reason why the market goes either higher or lower, to either attack liquidity pools or rebalance an imbalance. That is it. We've got the smart money paradigm, the pairing of liquidity pools under previous sentiment. So we know that the market seeks retail money, sell stops and buy stops, and we're going to focus on this understanding specifically. So this is the core of the 15-minute model, but I just wanted to say that every singular concept that I talk about is fractal, and every singular thing that I say, every singular framework that I use can be seen also in a daily chart, can be seen also in a weekly chart, can be seen in a monthly chart, and inside of a 1 second chart. The market is going to capitalize on previous sentiment on every singular time frame, meaning that this is the engine of price action. We capitalize on these people that do not see the market like we see it. We capitalize on unawareness. The next lesson that we're going to use is going to be session characteristics for the AM session and the PM session based on the daily accumulation, manipulation, and distribution. So, if we anticipate for the market to, let's just say, run higher, and we saw the London session consolidate, then what I would want to see for that day is for the market to go below the previous low, the previous session low, and then I would want to see that being the manipulation for the day. And I'm going to give you the visual aid, and I'm going to give you an example inside of this teaching. But basically, this is what I expect inside of this model. Then the next thing that we're going to use is going to be our knowledge about algorithmic delivery, algorithmic phases of consolidation, expansion, reversal, and retracement, because the market cannot do in the same time. The market cannot consolidate and then expand and then reverse in the same time. The market can also only go from consolidation, expansion, and then either reversal or retracement, but the market cannot go consolidation, reversal, or consolidation, retracement. The market can either go consolidation, expansion, retracement, or consolidation, expansion, reversal, and then retracement, and then expansion. And we also have the PDRA rule sets, which are for order blocks, fair value gaps, wicks, and standard deviations. So for order blocks, if we have the market going to the upside, if I'm looking at a bullish order block, what I want to see is the market going back into the order block and reject it. So for a bullish narrative, when I see the market retrace back into a bullish order block, I want to see the market reject said bullish order block and send the price higher. And if I'm looking at a bearish order block from the opposing, in this instance, the sell side of curve or the opposing dealing range, if I'm looking to the left and we're attacking a liquidity pool and I see a bearish order block, a rule set for that PD ray is for the market to close above its 50%, and that would mean that it fails. So if the market closes above or below the 50% of an order block, in this bullish instance above the 50% of that bearish order block, then we can we can use it as a means of support, but at the same time, the most important information that I get from that closing is the fact that that PD array failed, which means that we're going to go above. What we will find above is going to be a fair value gap. For instance, if the market closes above a fair value gap in itself, so I'm not talking about the 50%, I'm not talking about its low. If the market closes above this CB, then we're going to use it as a means of inversion, and that means that that fair value gap failed. These are the PDA rule sets, and also, in addition, if you're going to look at wicks, the wicks are gaps, so the wicks are seen as gaps. If the market closes above the 50% of a wick, then this means that the wick failed, and we're going to see an expansion higher with speed. So that is the consequent encroachment of the wick. And then we have the standard deviations. If the market closes above the standard deviation of, let's just say -1, then it means that we're going to go into the -2. So the first thing that you need for this model to be absolutely effective is to identify the highest probable day to trade, and that is going to be done through the weekly bias and narrative, because the weekly bias determines the direction. So I'm going to try and trade to the upside for this week, for the next week, and I'm going to choose which day is the highest probable. So the highest probability weekly direction, which is going to be either higher or lower, or consolidation, but if we focus on high probability trading, it is going to be either higher or lower. We have the high impact news drivers calendar plus the weekly accumulation, manipulation, distribution, anticipation. So for an NFP week, and I'm going to give you an example, I would only trade Monday, Tuesday, and then Friday. So I already know that I'm going to go with the idea in mind that I want to see the market go higher on Monday, Tuesday, and then Friday, based on the weekly accumulation, manipulation, and distribution anticipation, based on the high impact news drivers calendar. And exactly as I said, I will choose XYZ days to trade and go with the one-sided bias. A weekly bias example would be as follows, where the market opens, it creates the weekly low, it then goes to the upside, creating the distribution. So this is the accumulation, this is the manipulation, and this is the distribution of the week. So we can see that the market created the weekly low, and this is what we anticipate. We anticipate the market to create a weekly low, and this is when we're trading. And for instance, for NFP weeks, we will only trade Monday plus Tuesday, AM plus PM, Wednesday, between 7 o'clock and 8:30, and then Friday post NFP. The reason why we do this for the NFP weeks is because inside of Wednesday's AM session and Thursday, what the market will do is it will consolidate to create the liquidity pools for the main event. So the non-farm payroll, this is why it's an event. This is why it's a very important event, because this affects the whole weekly range expansion. So the NFP on Friday, for the market to manipulate the liquidity at the event, we first have to have some form of liquidity. So on Wednesday and Thursday, what the market will do is it will consolidate. And I also want you to understand that the NFP is either at the first week of the month or at the last. And mostly it's in the first week. And if the market is opening a new monthly candlestick, then that is going to have a high degree of volatility. So the market can still continue the previous monthly run for the accumulation. So the market opens and then goes to the upside on Monday and Tuesday, and the AM session, the pre-market on Wednesday. And then we can go to the downside, create the weekly low, create the weekly manipulation. And then for Friday's trading, we can continue or resume higher. So this is why we trade these days. I'm also going to give you the rule sets for the CPI week. For the CPI week, what we will anticipate, let's just say that we have the CPI on Wednesday. We will never trade the day ahead of CPI. So, based on a week that has CPI on Wednesday, I will never trade Wednesday ahead of CPI. So after CPI, it is completely fine to trade. I will never trade Tuesday, the day ahead of CPI, because the market will just consolidate to create the liquidity for this event. And Monday, I will never trade on a normal week. So I only trade Monday in NFP weeks. The reason being is the thing that I've said on the monthly opening. So instead of CPI weeks, we anticipate the market to consolidate on Monday and Tuesday. And then for CPI, we're going to anticipate the market to go below to create the low of the week on Wednesday. And then we're going to go in after CPI on Wednesday, Thursday, and Friday to anticipate this movement. And on Friday, we will anticipate, instead of the PM session, this weekly closing. And for FOMC, same thing. So we will only trade after these events. So if we have FOMC, let's just say on Tuesday, we will never trade Monday. We will never trade Tuesday ahead of the FOMC in itself. And then for Wednesday, Thursday, and Friday, we will anticipate only this to happen. And of course, Friday's closing or Thursday can do this. It is all that these are all variations, but I'm just going to talk strictly about the normal weekly expansion. So these are the main events that we are seeking. We have the NFP, we have the FOMC, and we have the CPI. And this is how we know in which day we're going to look for our bias for our direction. Now, we're going to go into the daily bias plus narrative. So, we already have an anticipated daily direction based on the weekly bias, because we decided that we wanted to see the market go higher on a weekly bias, on a weekly chart. We anticipated only to trade, let's just say, Monday, Tuesday for an NFP week, and then Friday. So we already have the day in which we're going to trade, Monday, Tuesday, and then Friday. We already have the direction. So our daily bias for Monday, Tuesday, and Friday is going to be higher. We will have an anticipated session characteristic or an expansion for the daily chart. So this means that on a daily chart, I will anticipate the market to expand higher. So therefore, for my AM session, I will anticipate for the market to expand higher. Then, after I know this, I will anticipate, and this is where the model comes in, I will anticipate the opposing previous session liquidity pool to be taken instead of a 15-minute chart. And for the AM session, what we do is we attack London liquidity or the previous day PM session liquidity. For the PM session, we will attack the lunch liquidity, and for the lunch session, we attack AM session liquidity. And this is going to be a crude depiction of this intraday model. This is also going to be an example that I've had live. But again, I want you to understand that this is how I built most of my understanding based on this only model. I never switched away from this model. And I believe the reason why I've chosen this model is because I understood the logic that the market, as smart money traders, we capitalize on retail money. We capitalize on these unaware people. So I've based my trust on this model just because this is purely logical. So what you can see here is the daily range from the perspective of a rather lower time frame chart. And let's just imagine that this is a 15-minute chart. If I am an AM session trader, what I will anticipate is for the market to consolidate in London. I will anticipate for the market to take the London session sell side based on a bullish daily bias. And I never worry about this movement going lower. I never worry about it going even lower because I've made my homework, I've done my homework, and I understand that the daily bias is correct, that the weekly bias is correct. So I never have to worry of whether this is going to work or not. So if I am an AM session trader, I will anticipate the market to go below the London session sell side, and then I will anticipate the market to do what? After a consolidation, we have the expansion. After the market has gone and consolidated again, we have the expansion to the downside. And I anticipate the market to do what? I anticipate the market to reverse because I see this expansion as means of manipulation for the daily chart. So if we would have an accumulation, manipulation, distribution, how can I say this? Diagram. This would be the opening price. The market created the low of the day here, and then we expand higher. Market consolidates, goes back below this low, and then we can continue to the upside. So this would be the daily manipulation. This would be the daily low. So we anticipate the market to expand. We anticipate smart money to accumulate longs here below the long sell side because all of these people that went long here, what they do is they will trail the stops here, or all of these people that see this as a means of support, they will have buy positions here. So the market has to go below, take both of these retail mindset traders out, and we will long here. So this is what we anticipate inside of the AM session. For the PM session and for the lunch session, mostly the market goes back for lunch sell side. Not for lunch, my mistake. Instead of the lunch session, the market will go back to AM session sell side. if we're going to go to the upside. So the market is going to attack some form of liquidity that was formed during this run. It will consolidate a little bit. This will look like a consolidation on a 15-minute chart. And if you are a PM session trader, and if you have a daily target here, and the market never reached it inside of this day, then what you will expect between 13.30 and 16, you will anticipate the market to go below the launch sell side here, and then you will attack launch buy side. This would be the model for AM session and PM session. And I know that most of my students, including you, are focused on the AM session. So this is your model. And this can also be the previous PM session sell side, the previous PM session buy side. So the previous day, if we're going to look at the previous day, between 13.30 and 16, the sell side, the lowest low that is within that session, that is going to be your liquidity pool. And the reason being is because if we are going to look at the regular trading hours, if we're going to look, you're going to have a switch here instead of your NASDAQ chart, instead of the futures contract. There is a difference between ETH and RTH. ETH stands for electronic trading hours, and RTH stands for regular trading hours. So before the market was done electronically, the market would be open for the AM session between 9:30 and 12 o'clock. And 12 o'clock to 1 o'clock, that would be launch session. And then the PM session between 13 to 16. And this would be the market. Now, because we have the electronic trading hours, we also have the midnight opening. But the market still allows you, and the market still capitalizes on seeing only the regular trading hours. So what will happen is you will have the 9:30 opening as the daily opening, and the previous PM session, imagine this is the previous PM session, is still going to be very close to you. So where the market opens at 9:30 to where the market closed at 17 the previous day, this is going to be the difference. So you can anticipate both the London session sell side, but if the market is not near the London session buy side or sell side, then you're going to anticipate the previous PM session. And for the 1 minute execution, we have the rule set. What you will do after you see your 15-minute model, where the market goes below a means of previous session sell side, is you will anticipate a 1 minute market structure shift inside of a macro time period. And that is going to be the AM session. For the AM session, the 9:50 to 10:10 macro, and the 10:50 to 11:10 macro. For the lunch session, you will have the 11:50 to 12:10 macro and 12:50 to 13:10 macro. And for the PM session, 13:50, 14:10, 14:50, 15:10. And of course, you're going to target opposing previous buy side and sell side liquidity pools. And this is a beautiful example of what I did inside of March. I'm going to quickly explain to you what this execution is about. Also, the other annotations they're not really that important, but I'm just going to go through this screenshot, and I'm going to explain to you the logic and the exact model that we used inside of this execution or inside of this study that I've done. So the time period in which I'm looking at is the 9:30 to 12 o'clock, the AM session. And inside of this day, because we had a CPI week, this was Wednesday CPI expansion. So at 8:30, the market went to the upside. I do not care about this. But what I will do, I understand that the market now is entering the weekly expansion. So what I want to see from this, after the CPI has ended between 9:30 to 12 o'clock, I want to see the CPI sell side being taken. because my daily bias is what? Bullish, because I was anticipating the week in itself to be bullish. So I see the market going back below the CPA sell side. And this is where I anticipate the market and smart money traders to accumulate longs. And this also correlates with my time period, because this is 9:30 and this is between 9:50 to 10:10. Now, we saw this happening here. What do I anticipate for the market to do? I anticipate for the market to shift now. So imagine you're looking at a 15-minute chart. I saw this low being taken. The next thing that I'm going to look for is I'm going to switch to the 1 minute, and then I'm going to wait for a market structure shift. How do I find the market structure shift? What is the high that is responsible for this low being made? This low is responsible for this low to be for this low that was taken. But this is the high that sent price lower to this low. So this is the one that will frame my market structure shift. Also, after this happens, after the market goes below the sell side liquidity from CPI, then I will start looking for only bullish movement. So from here, what I see is the market trapping all of these people short. I anticipate between 9:50 to 10:10 macro, I anticipate the market to shift. So this means that I want to see the market go above this fair value gap. That's one PDRA. The second PDRA would be this fair value gap, or this one. It has no relevance. So I want to see the market close below this. For this PDRA to fail, this would be the second PDRA. And for the third, this would be the order block, the 50%, the rule set. And we indeed closed above this. So this is why this market structure shift is relevant. So this means that the market has now shifted to a bullish program. So we're now going to look for high prices. And all of this happened, again, between 9:50 and 10:10. Now, what I'm going to look for is my chosen PDRA. And I never told you what PDRA to use, because I understand that your PDRA of choice is solely personal. I would encourage you to use a fair value gap, because this is what I used most for this model. But as I got more advanced, I switched to inversion gaps, and eventually I have more signatures than the current PDRAs allow me to show. So I used, instead of this model, the market closed above the inversion fair value gap, so I anticipate the market to go back into it and use it as a means of support. This is what we did, and this would be your entry. And you know that the market does not have to go below this based on rule sets. But essentially, this is your entry. What am I going to target STO? Well, this here, the pre-market CPA buy side, and a standard deviation level. If you want to do standard deviations from this, or this even, this is a manipulation leg. This one, even this one, this retracement. But the market eventually expands. It reverses here. The market retraces back into a fair value gap. Expansion, retracement, expansion, a little retracement, and then we close and we fully go above for the buy side. So, as a quick recap, our model is solely based on the weekly chart. From the weekly chart, we will anticipate the days in which we're going to trade based on the high impact news arrival calendar. We already have the direction, and we already have the days in which we're going to trade. Next up, instead of a 15-minute chart, when that day comes, I anticipate a previous session liquidity pool to be taken, and then instead of a 1-minute chart, I will anticipate the market to do a market structure shift, and I will then long either a fair value gap, either an inversion fair value gap, what you prefer, inside of a 9:50 to 10:10, 10:50 to 11:10, macro if you're trading the AM session. If you're trading the PM session, I will anticipate the market to do a market structure shift between 1350 to 1410 or 1450 to 1510. So this is the teaching about the model that we're going to use. This is what we're going to base our signatures on. And this, my friend, this was it for this session. So I hope you understood very well the model. And what I want you to do for the next session, I want you to go into your own chart and find this model. Voice crack. Find this model. Do your narrative from a weekly chart with the rules that I gave you for the CPA week, for the NFP week, and for a normal week, because I never told you. For a normal week, we are going to never trade Monday, because Monday never has any high impact news drivers, mostly. So for a normal week, we're going to trade Tuesday, Wednesday, and Thursday. And we can anticipate for the market to do the high of the week on Thursday and Friday. So this is why I sometimes skip Friday. But mostly, this is what I anticipate, and this is what I want you to write down as notes for weekly high impact news driver calendar. And I hope you understood very well. Again, what I want you to do is go in and do a weekly narrative and weekly bias, and then you're going to go into your intraday charts and you're going to study with this model in mind.